I would like to present the report, Sending Money Home for Europe. As you know, this is the report that sort of set the stage for the rest of the discussion. So you're going to have all the facts and the figures and the numbers that you need to fit into the rest of the debate. We have had 4 previous events, and we have had 4 sending money home reports already issued, including this one. The first one was the global sending money home report. There was one on Africa. There was one on Asia 2 years ago, and this year is going to be Europe. So the numbers that you're going to see are mostly focused on the European flows and market. And the report, which was embargoed until today, is available at coffee break. You will find it on the coffee tables outside the room. So before we start the presentation, I would like to remind you about 4 numbers, global numbers, just to set the context. And these 4 global numbers you already heard this morning, but just to refresh your memory. The first number is 250 million international migrants worldwide in 2015. So this gives you a number of how many people are we talking about that are the subject of this conversation. The other number is the number of actual remittances in terms of money, and the number was mentioned of 436 billion in 2014. This is the total number of remittances going around the world. Third number is the number about the cost of transaction, which currently runs around 8% worldwide. And finally, the number of 40% of all remittances go into rural areas, which is to some extent what justify an institution like IFAD interest into this phenomenon, is mostly because this represents a huge inflow of money into rural areas, which is where our main clients live. Okay, so remittances from Europe. This is about 109 billion US dollar right now, and it represents about 50 million migrants living in Europe. These remittances benefit about 150 million people that are benefiting from migrants from remittances leaving Europe. So now Europe is a major sending region after having been historically a net receiver of remittances for much of the previous century. Europe has about 10% of the world population, 20% of migrant workers, as we said, about 50 million. And Europe is a source of about 25% of global remittances flow. The first hub is the United States. The second hub is Europe. So where do people come from? Where do their money go? And which regions rely the most on Europe? Migrants in Europe mainly come from Eastern Europe, about 40%, followed by Asia, 25%, and Africa, followed then to a lesser extent by Latin America and Near East. Where does the money go? Actually, money mostly goes to Europe itself. And Eastern Europe, Baltics, Caucasus countries are the main beneficiaries of European remittances. So 1/3 of all remittances from Europe go to Europe. 2/3 of the rest of the remittances flow to developing countries in regions outside Europe. Asia receives the largest amount with 35 billion. Which regions rely the most on European remittances? Again, mostly Eastern European countries. They rely, of all remittances, they rely on European remittances by about 80%. North Africa and Central Asia are the regions beyond Europe that most rely on European remittances, largely from France and Russia. Every country in Europe has its own more or less preferred destinations. Latin America and Caribbean receive most of it from Spain, etc. On the sending side, the top 10 European sending countries represent about 82% of total outflows. The top 6 sending European countries are Russia, UK, Germany, France, Italy, and Spain. They're also among the top sending countries worldwide. Russia is the top sender with about 20 billion US dollars, almost all to Eastern Europe and Central Asia. How much does this represent from the sending country? We can say more or less, there are averages of course, but the flows represents about, let's say, 0.5% to 0.7% of annual GDP of an individual country. In comparison, this money, these flows, are often 50% or more of the income of receiving households in developing countries, and can equal up to 40% of receiving countries' GDP. Now, of course, this varies a lot from one country to the other, but it can be as important as 40% of GDP. Now, of course, when you look at the outflows going out from the sending countries, you can also have to factor in the fact that this outflow actually have coming from a generated economic output, of which this represents only about 20%. So of all the money that migrants workers send home, they send home more or less on average a fifth of what they earn. So if we think that this represents about 0.5% of GDP, it means that this actually migrants workers output, economic output, generate 2.5% of GDP that stays in the country where they live, where they work. So it's not a drain, it's actually an additional value that they generate in these countries where they work. In fact, the European diaspora has about 100 billion accumulated savings in the countries where they work, beyond the remittances. Just some highlights that shows the importance of how the migration is distributed among the sending countries. As we said, migrants in Russia send the most remittances, about 20 billion, to Central Asia and Eastern Europe. Turkmenistan, Uzbekistan rely fully on the Russian Federation for remittances. Flows from the UK is about 17 billion. 50% of the flows from the UK goes to 6 Asian countries, mostly India, Pakistan, China, Philippines, Bangladesh, and Sri Lanka. In Europe, the main recipient is Poland, and in Africa, the main recipient is Nigeria. Flows from Germany is about 14 billion. The main beneficiaries are Poland and Turkey. From France, about 10 billion, mostly going to North Africa, sub-Saharan countries. And flows from Italy are more diversified. They are going mostly to 3 regions, Asia, Europe, and Africa. And those from Spain goes mostly to Latin America. So as we said, from Europe, the receiving countries in Europe, they receive about 1/3 of total remittances. So it's about $36 billion. This is led by Ukraine, Poland, Serbia, and Romania. The 9 non-European countries which are mostly, that are receiving most of these remittances are actually mostly agriculture-based economies. These are mostly where the importance of the rural sector is particularly high, with 35% of the population is employed in the rural sector. So it shows again the importance of remittances for the rural sector. Remittances from Europe represents an important share of GDP for some countries, like Moldova is 22%, Kosovo is 17%, and Bosnia and Herzegovina is 10% of GDP. Now, remittances as a percent of GDP, again, in non-European countries, can be between 2% and 25%. Now, just now, a word on cost. We heard a lot about cost already this morning. The average cost of sending money home from Europe is about 7.3%. So this is slightly below world average. But if we look at the performance of Russia, Russia is actually at 2.4%. So this gives you an idea that it's actually possible to lower the cost of sending money home still by a large margin. And as we have heard this morning, there are some major drivers of costs. One which is competition. So it depends how competitive the market for the money transfer operators is. But also the availability of a network of payout locations, particularly in rural areas. But also the density of these corridors. Clearly, if you have high-density corridors or the amount of transaction being relatively low, you have more economy of scale, and then you can reduce cost. It has been estimated that a reduction to 5%, so from 7.3 to 5%, would save migrants and their family more than $2.5 billion of transfer cost that would basically stay in their pocket. So this is a big area of improvement of efficiency that we can still work on. Who are the main operators? The main operators are the money transfers operators. There are about 200, sorry, just to start that, there are about 200 remittance service providers in Europe. So it is on paper at least, relatively competitive market. There has been an increasing number of operators coming into this market. Most of them, as I was saying, are MTOs. 70% of all remittance service providers are MTOs in Europe. So these MTOs operate with their own license or in partnership with banks and postal networks. Then you have the banks. They're also major collector and distributor channel for sending and receiving remittances flow. They mainly act as agents for MTOs, but they don't necessarily provide financial services to the clients. They're basically an outlet of remittances. And this is where the agenda is on the financial inclusion, how we can provide more services, financial services from banks. But I'll come back to that later. Postal networks have becoming more increasingly important in this market, mostly because of in some countries, the wide distribution networks that they have. So particularly in rural areas, if you have to access a payment post, sometimes you rely on postal networks to do this. And finally, mobile operators of online services. They're less expensive. They provide a good alternative for receiving money in rural areas. But there are some issues here. Some are related to the regulatory frameworks, particularly in Europe, that still require some harmonization on how the mobile technology is being used. And some banks are increasingly reluctant to host the account of innovative technology-based operators. Online platforms exist. They offer less expensive product, but they still struggle to convince their clients. Now, beyond the numbers, we would like just to say a few words about what this means. In essence, what are we looking? Why are we so interested about this phenomenon of remittances? And here, really, we would like to insist on the three pillars that we think are fundamental to really look at opportunities provided by remittances. The first is access. We really want to go beyond access and look at use. And beyond use, how this use can be leveraging investment. So it's really this triptych approach between access, use, and investment back home that will really generate all the potential of remittances. Because financial inclusion is not just about facilitating access. It's also about promoting use and financial services and eventually generating investment. So what is it about access? Well, access is a lot about retailing infrastructure. We talked about this when we talked about payout locations in rural areas. It's a lot about competition. It's a lot about information. It's a lot these days about new technology coming on the market, particularly mobile technology, that can substantially improve efficiency for access. Let's not forget that women and rural households are the most excluded from this market. And in this respect, clearly, there is still a lot to do on the access side. On the usage side, as we said, currently the market is mostly driven by MTOs. But financial institutions have a unique opportunities to look at the services, to look at serving remittances client with more than just remittances payment services. And there is clearly a lot more that you can do in terms of financial inclusion by promoting account-to-account type of transfer that allow the recipient families to have an account and become more of a formal client of these banks that then are in a better position to provide additional services. And finally, investments. Investment back home. This is all about the leveraging agenda. I think we mentioned this a little bit, how to maximize impact of this money once it reaches the communities. And this is really, we're talking a lot about financial education, a lot about developing new specific products, and seeing remittances almost like a collateral to mobilize additional credits from banks. So this will really enable a development agenda that will create jobs and small enterprises and potentially really develop the rural areas and to a large extent reduce the pressure to migrate. A couple of final messages in terms of policy implications. There are some policy implications first related to regulatory frameworks. There is still quite a lot of work to do on the regulatory frameworks. We heard about this morning. It goes from, one, the concern about making sure that we know what this money is being used for a good purpose, for individual development, but also that we are limiting the risk of seeing this money being used for financing terrorism or money laundering. Clearly, there are trade-offs. The more you regulate, the more you may actually increase costs. So you have to find the right balance between regulating and increasing competition, reducing cost, and expanding the financial options and lower the risks. For instance, we talked about new technology for money transfers. The cost reduction issue could be enhanced by promoting diversity among remittance service providers, limiting the exclusivity agreements that there are between MTOs and banks, and we heard Mr. Sutherland talk about that, and incentives for low-cost transfer systems, particularly in terms of the retailing and the payout networks, and we mentioned postal systems. Third is the leveraging agenda, the leveraging the impact of remittances, which is required for development strategies in receiving countries. And this is really where institutions like IFAD can facilitate this agenda by promoting efforts to help communities, help individuals to approach banks with better products that can promote investments in their own communities. And finally, that remittances really count the most in rural areas. This is, for many people, the lifeline against poverty and an opportunity for scaling up development. Small money count the most there because the very limited penetration of financial systems in rural areas. And this is where the impact can be the greatest. And I would like to end with this slide, which is really about a message that this is their money. Let's never forget that this is private money. This is money going from one individual to another individual. And as we hear the amounts, as we hear the importance, as we hear the magnitude of the phenomenon, we start hearing comparison between remittances and ODA. And the temptation is very close to say, oh, well, if we have so much remittances, why bother about development? Why bother about public aid? Resilience will take care of development. And I think this is a bit of a stretch of imagination by thinking that we in the public sector can actually look at remittances like with eyes that says we can actually save money because of this. And so we shed some of our responsibility on the development itself. And so this is the point about remittances being private money, and this is really depending on their willingness to express their solidarity with the family and nothing more. But clearly there is a lot we can do to facilitate the process in terms of offering more options. This is essentially what we are here about. And one of the options could be actually as we said, to shift transaction from cash to account. If we're just doing this, we'll facilitate the integration in the more formal financial sector and will provide better financial services in the receiving countries. The use of new technology offers new opportunities for reducing cost and for making it more transparent and for better linkages with the banking sector. Financial education is extremely important. Many banks or the clients, the families that receive this money don't quite know how to best leverage this money in the banks that they serve. So it will be quite important to provide financial education for both senders and receivers. And of course, let's not forget that through remittances, there is a lot of savings that are being generated. So some savings stay in the countries where they are earned, some savings are generated in the countries where they are received. Remittance can also establish a credit history, or at least start to establish a credit history, which you know is how important that it is at the beginning when you start entering the financial sector to be able to provide a minimum of credit history so that you can get credit from these banks. As we mentioned, the importance to offer more options to invest. And the bottom line is really that remittances, financial inclusion, and community development will reduce poverty, generate employment, and reduce the pressure to migrate, or even create the condition for reverse migration, as I believe that families do not have any particular incentive to remain divided from their families if the economic and social conditions are available to be reunited again. Thank you very much.
Thank you, Adolfo. For our next session, for unforeseen circumstances, the representative of the Global Forum on Migration and Development from the Turkish chair could not be here. However, we will have a presentation from the G20 2015 Turkish presidency, Mr. Yakup Asarkaya, who will, as you know, since Turkey